Hey there, Wall Street winners. This video is about taxes and the tax brackets, how much tax you pay on your salary, your employment income versus the wealth that can be created through investing and the benefits tax-wise of some of your investment income as opposed to your employment income. So let's take a look at how your employment income often generates less after tax money in your pocket than, say, an investment like a capital gain. And a capital gain would be described as the appreciation of an asset. So if you bought a stock for $100 and sold it for $110, the gain in capital would be $10. And that is ultimately what allows your money to work for you without you working for your money. And that capital gain is taxed differently than your employment income or a salary. So this video is intended to give you a basic understanding of taxes. We're not going to go through the tax code here. We're going to keep this light and simple, but the basics are this. Taxes on income, which is a salary, employment income, are typically bad because they're higher. Taxes on capital gains are better. Taxes in general aren't great, but if you understand the tax system, the way certain things are taxed are better than other things. And capital gains, or the appreciation of an asset, could be a fixed asset like a house. Now in Canada, if your house increases in value and it's your personal residence, there's no tax on that capital gain. But if you own a second property, like a cottage or an investment property, and you paid $1 million for that second property, and then at some point in the future sold it for $2 million, it's doubled in value and you'd be taxed on that gain. Now, there's elements to that we'll get into because you're not taxed on the whole gain, which is, again, part of the benefit of capital gains. So income taxes. This is typically for, it applies to a lot of different countries, but the scenarios that I'm going to give details on here are specific to the province of Ontario, because I live in Toronto, Canada, and the country of Canada. So we pay two types of taxes. We pay a lot of taxes in Canada, but from an income and a tax perspective at the end of the year, when you file your income taxes, as they call it, which include your investment taxes, it doesn't include things like sales taxes, which would be tax on purchases that you make throughout the year with after-tax dollars. So remember that everything you're buying is with after-tax dollars. So you're paying additional tax as well. But we pay two types of tax. We pay provincial tax and we pay federal tax. Provincial tax goes to the province, and in Ontario, the province is managed out of Toronto, the provincial government, and we pay federal tax. And in Canada, the federal government is out of Ottawa, and the taxes go to the CRA, Canada Revenue Agency, in Toronto. Sorry, in Ottawa. Provincial in Toronto, federal in Ottawa. So taxes in Canada are called progressive, which means the more money that you make, the higher the percentage of tax you pay on that money as the amount of money increases. So we have what's called tax brackets, which we'll get into next, and the percent paid on each of the brackets increases as the amount you make increases. So the higher your income, salary, and investments, the higher the percentage of tax, or your effective tax rate, combined tax rate, becomes. So if you look at the federal brackets on the left, you can see that if you make up to $55,867, you'll pay 15% on that. So it's a relatively low amount, but that's also a relatively low amount of income to live off of based upon the cost of living these days. For every dollar after 55,868 up to 111,733, you're going to pay 20.5%. And then anything above that 111,000 up to 173,000, you're going to pay 26%. So it's basically going up by 5.5% in the first three brackets. Then it goes up by 3% to 29% on anything between 173 and 246,000. And if you're in the top 1% of income earners in Canada, and you're making above $246,000, you're going to pay 33% on every dollar over 246,000 that you earn. Now, this is just to the federal government. Then to the provincial government on the right in the Ontario brackets, you're also going to pay tax. So you're going to pay another, in addition to the 15% you paid on the first 55, on the first $51,446, you're going to pay 5.05%. And then above 51 through to 102,000, you're going to pay 9.15%. So this increased by, call it roughly 4%, and then another 2%, 1%, and another 1% in the provincial brackets. So anything above 220,000 provincially, you're going to pay 13.16%. So here you're looking effectively at 33% federal plus 13, so 46 plus percent on income above 246,000. So it can be quite meaningful when you take a look at this. So let's look at how this all breaks down when it comes to capital gains. So capital gains is money that you can make by investing your money in assets, things like stocks or real estate that appreciate in value and grow. And capital gains are taxed differently than income. And income would be your salary from employment or interest income that you'd earn, say, on a bond or a GIC or a bank account that pays interest. So you pay the highest amount of tax on income from a salary or interest. In Canada, you only pay tax on 50% of your capital gains. So if you made $100 in capital gains, you'd only be taxed on 50 of those $100. So half of that $100. And that doesn't seem like a lot, but when you extrapolate that out to say $100,000 of capital gains, you're only paying tax on 50,000 of those. And that allows for wealth accumulation to occur very quickly. So let's take a look at an example of someone who would be considered highly paid in Canada. This is Dr. Naveen, very handsome man, smart, obviously highly educated, highly paid. His salary is $250,000 Canadian a year. So he's a top 1% income earner in Canada. And if you look at how that $250,000 in income is taxed federally on the left-hand side, you can see the breakdown of percentages by the different tax brackets. And then the total federal tax he pays is $58,087. Of that $250,000 income, on the right-hand side is the provincial allotment. So to the province of Ontario, he'll pay another $25,025 for a total of $83,112 gets paid out of the $250,000. So he doesn't take home $250,000. He takes home $250,000 minus $183,112. So that would be his take-home pay. Then we look at another example. This is a cute little girl who's obviously of age to work. Her name is Dora. She's smart. She's educated. She speaks multiple languages. She loves exploring and travel and investing, and she's quite a savvy investor. Now, her salary with her travel agency and tourism business is only $50,000. So it's on the lower side. But in capital gains, she makes $200,000 a year off of her investments. Now remember that the taxable portion of capital gains are only 50%. So of the $200,000 in taxable capital gains, in capital gains, she pays only $100,000 of that as taxable income. So her total income is half of 2,000, which is 100,000, and 50. So 150,000. Half of the 200,000 plus the 50,000 is 150,000. So on the left-hand side down here, you can see the federal breakdown. So federally, she's going to pay $29,782 in federal income tax. On the right-hand side, she's going to pay to the province of Ontario $12,565 for a total of $42,347. So her take-home pay at the end of the year, because she's brought in the same amount, $250,000, but because capital gains were taxed a lot more efficiently, she actually has more than $210,000 in her pocket, which is a lot more than our Dr. Naveen. So being highly paid in Canada as a salary does not necessarily mean that the money that you take home at the end of the year is more than someone who has a lower salary, but has decided to invest more and is more savvy in their investments. So let's compare the two. Dora has an effective tax rate of 16.9%. Now, her salary is lower, but in the end, she is much wealthier than Dr. Naveen. Dr. Naveen's effective tax rate is 33.2%. Now, yes, his salary is higher, and he'll make that salary every year because as a doctor, it's pretty much guaranteed, and it's probably going to grow with inflation. But he probably has a lot more student debt for the years of education required to become a doctor. He's probably incurred university expenses. And in the end, he's not as wealthy. He's actually poorer on a take-home basis than Dora is. So the key lessons to take away from this is understand that a high income in terms of salary means you pay more tax, but you probably also have increased expenses from university, which have to be paid back at some point, and you're likely working as an employee. So it's better to have your money work for you than you working for your money. And how do you do this? You do it by looking at your paycheck every month and allocating as much in percentage terms as you can to an investment account and allowing that money to grow and create capital gains for you over time so that that money goes to work for you. So paying yourself first is the most important lesson. Take 10 or 20, 50% if you can, but 10 or 20% is a great amount to just pay into a separate account that gets invested in an S&P 500 index fund and just grows at an average of 10% a year over the course of multiple years. And that compounding effect will make you a very wealthy person that achieves a level of financial freedom that most people can only dream of. Good luck in your trades. And if you like these videos, leave me a comment. Tell me what else I could explain to you or how I can help you, and subscribe to the channel.